Well, good afternoon, everybody. Welcome to the August 23rd edition of Bull Sessions. My name is Mark, just back from vacation Robertson, and I'm joined here by Ken Cavula. How are you, sir?
You still got sand between your toes, huh?
Something like that for sure. And Kim Butcher may be joining us today, but she was preoccupied with some other stuff. So I am literally backsliding off of vacation. I have to confess, I barely touched my cell phone. I barely touched my laptop for a week, and I think I'm going back.
That it feels good, doesn't it, Mark?
It does. I read words on paper pages, Ken.
I haven't looked at email, Mark, since last Thursday, so I'm dreading how much email I have to answer, but I'll start that tomorrow again. So
Yeah, I've made a pretty good trek through my email, so at least I'm partially back. So I like the word backsliding. It's one of George Nicholson's favorite words. I'm not sure what it means, but I think it means something like what I witnessed here over the last several days. You know, I go out of town for a few days. I leave you in the hands of Serena Williams, and with the bull market in progress and everything progressing nicely, and I come back and the graphs that I'm looking at look like the ones on the left there.
well, to be fair now, there was a lot of debate about whether we were in a bull or a bear market when you left. Okay.
Well, yeah, and apparently the Bears took that one by the horns, and they're ratcheting away. So the curmudgeon there in the center of the screen, not Jim O'Shaughnessy, the other one, the second image in, that's just me trying to catch up on a couple weeks worth of data. I'm making pretty good progress, but man, it's a sludge. The guy in the middle of the screen kind of does bring everything back to normal. We'll talking about him for a few minutes. Jim O'Shaughnessy, and he's the one that wrote the book "What Works on Wall Street," and have some fun. Now, I put Serena in charge when I left a couple weeks ago, and you guys have kind of let me down with the stock market, so we'll talk a little bit more about that. And Friday was ugly, and so was Monday. Apparently, Friday and Monday, we gave back everything that had been gained over the last few weeks. So,
I did see, Mark. I did see about 3 hours ago that they said that the NASDAQ was back in positive territory for the month of August. So at that point, something was happening to balance things out with the NASDAQ at least. But that might have all evaporated in the last 3 hours also. I haven't looked at where the markets are right now. So
in the day
we have to get out of this habit of looking day by day, don't we?
Yeah, every day seems to be different, and the market behavior does seem to be changing a little bit, but we too have seen this movie before. And we'll close out today's session with a look back at the last couple of years and some of our favorite sessions and themes. So let's go ahead and get underway, Ken, while we still have internet.
All right. Sounds good.
Here's our standard disclaimer. No investment recommendation is intended. Everything is about demonstration. It's about illustration of some philosophies, methods, techniques of the modern investment club movement as we interpret them at Manifest Investing. So you're going to hear opinions from us. Please do your own homework before making any decision. We're not going to talk quite as much about individual stocks today, but we often do during these sessions, and everything that I've seen in my review of what you seem to like means that we need to do even more. We do try to remember to disclose when we actually own something that we're talking about. The roundtable is 1 week away. We will be doing the August roundtable a week from today. If you'd like to be added to a reminder list, please send an email to ncavula1@comcast.net. And then again, especially after we go through looking back over the last couple of years of these bull sessions, if you have suggestions for future topics, bring them out. My email address, markr@manifestinvesting.com, is there. And Ken and I communicate anytime we receive suggestions for future topics. And his email is kcavula1@comcast.net.
I will just inform you, Mark, that I will just inform you that yesterday Natalie informed me that our list went over 1,500 people, our guest list, yesterday when she was putting a couple names in. So we are now talking to 1,500 people outside of the Mid-Michigan chapter when we send out our I don't know what they're not warnings, but we send out our note that says we have registrations open for the roundtable. So we'd be glad to have you there, and the more the merrier. It's 8:30 Eastern time a week from today.
And if you're unfamiliar with the roundtable, we are going to be talking about that briefly during this session. All right. Here's a quick reminder. We did start 2 Julys ago, so it's been a couple of years. The bull session is meant to be kind of an informal. It's kind of a little bit of what I'm working on, what Ken and I are discussing. Really just meant to be an open gateway to talking about things that could be of interest. I don't know about you, Ken, but I think I'm very enthusiastic about some of the places we've been and could be going. So I say we just keep pressing on and see. As long as we keep people's attention, we can keep building on what we've been doing.
And I'd like to repeat, Mark, your what you just said to the audience in case they didn't hear it. There goes that sound bar again, Mark, up on your screen.
Yep.
And we're all seeing it. I don't know if that's the one you were trying to get rid of earlier, but it's back again.
Okay, we'll tell it to behave.
All right. I just would like to remind folks that this bull session goes anywhere that we want to take it or anywhere the audience wants to take it. So give us your ideas. Tell us what you'd like us to talk about and get us involved in new things. We both like to deal with new things just as much as we like to revisit some of our old favorites. So tell us what you want to hear so that we can keep this interesting, not only for you, but for us as well.
All right. All right. This is how I kind of left things a couple of weeks ago before I went on vacation in Serena's hands. Figured, with my drinks alongside the lake, everything was, chugging along very well. The bear was asleep. I just love that expression by Serena because of those of you that have attended sessions that Ken and I've put on, especially if you're a beginning investor, but I think it really rates for all of us. We like to say, be a sponge. Just get out there and soak up everything you can with respect to what you're trying to do. In Serena's case, that was become the best player in the history of tennis. We're just trying to become successful investors. So I just love that outlook that she has in her approach to.
So, Mark, is that bear resting his head on a sheep or a rock?
Well, it's not a bull. No, that's a rock, I think.
That's a rock? Okay.
No animals were harmed in the making of that slide. And of course, the otters are just showing how you can float even in rough seas when you do it together and do it well. All right. So again, I left you in Serena's hands, and you guys kind of blew it. How bad? Here you go. Here's the QQQ over the last few months, and you can see that as I went on vacation, things were going along swimmingly, and I'm holding all of you responsible for this one. Pretty nasty dip they're taking. I mean, look at the power and strength going into vacation, and what's happened since then. So, Ken, what do you have to say for yourself?
Well, I just think it's we're in the middle of something that I've lived through a couple of times before. I don't feel nearly as panicky as I have or as I did in the 80s or the 90s or the what do you call them? The aughts when you've gone past 2000 to 2010, that particular decade. But there's still times when you're laying in bed at 3 o'clock in the morning and your heart starts to beat a little bit faster and your mind gets going and you have to remind yourself that if everything's going to go to pot, then it's no use worrying. And if this is something that I've seen before, then there's also no use worrying about it. So I would like to see it stabilize a little bit now, but 2 days does not a trend make. 3 days does not a trend make. I'm not sure that 2 weeks makes a trend even. So it is what it is. Isn't that profound? Okay.
Well, yeah, and some would say 2 years don't make a trend. So, and
I
it's a
tend
rough
to agree with
perspective.
that, Mark.
Yeah. So, the definition of a bull market we had advanced since the tough times in May and June, a full 20%, and that has kind of fallen apart. So, like you said, Ken, people are arguing about the definition and qualifications for it. Here's one of those right here. A 20% net gain in the Nasdaq does not equal a bull market, and I just found it kind of interesting that they're wrestling over, is it 20%, is it 30%? It doesn't really matter. I mean, we really don't care about this. We invest in stocks, not markets, and under all conditions that we have seen over the last now 8 decades. I've only seen part of those 8 decades myself personally, but over the last several decades of investing, I've never seen a time when there wasn't something of interest, something, uh, an excellent company at a decent price, and that continues to be the case now. We just have to keep finding them. Here's a quick look at the
I
value.
listened. I listened to David Faber and Jim Cramer this morning for a little bit, Mark. I'll admit it. And I heard Mr. Kramer say, for all of you that are listening right now about the stock market, he says, my advice to you is turn the TV off and do something productive. Okay,
Kramer
so
said that?
maybe that's what we have to do occasionally is just turn the TV off and go do something productive or do something that's beneficial to your emotional or social life rather than work constantly about your investments.
Well, I can tell you, I definitely experienced that over the last week because I didn't even know what was going on. And that's okay. Um, I
Yep.
do find this look kind of compelling because we put up a similar chart every week at bull sessions, and this is a 20-year look at the value line arithmetic index, and I think this shows fairly well that we've been through a really weird 2 years, going on 3 years, and when you look at I mean, fairly typical market. By the way, this is a really nasty moment in stock market history, so let's not uh, uh, miss that. So was the COVID moment. This is pretty ugly. But what I like to point out, I don't know if like is the right word, but this is really a staggering run in the stock market from mid 2020 through mid 2021. And you can see you know, the monthly highs and lows are actually pretty extreme on this chart. And that's natural, but this is even a little bit out of the realm. So again, this notion of, are we just kind of coming back to a longer term trend here? I don't know. Probably. I think we probably overshot fairly significantly there in mid 2021.
Well, I found a lot of people that I always had considered very conservative investors talking to me in language that I didn't consider as conservative as they usually spoke. And I'll admit to being one of those on occasion, looking at stocks and making excuses for the fact that they were just flat out overvalued in a lot of cases, making excuses for stocks that didn't make any kind of a financial profit, didn't have any earnings, and making excuses for hoping that things would work themselves out according to the way the founders or the new leaders of the company said that the company was supposed to work. In other words, making exception after exception after exception. And I think you might be onto something, Mark, that we've we've kind of moved to a place that might end up being back on trend, and there's nothing wrong with being back on trend. We overshoot in both directions. Maybe we overshot a little bit to the upside, and we have to come back a little bit to stay on trend.
Well, a few months ago, we did a program on dropping a boulder into a swimming pool and noticing what happens with the ripples and constructive and destructive resonance and all that stuff. I think that's really what you're looking at here. You've got one extreme here, one extreme here. It is a pendulum. The thing I do like to point out is from left to right on this chart, we are still looking at this number as of today. And it's, it's right in that 10 or 11% range. So it's really not that unusual. So we really do have a couple of pretty nasty ripples there. And all that upper ripple did, because things do get overly exuberant under certain conditions with that run up in the stock market. We know from history and from experience that companies like the companies that Kathy Wood was investing in are precarious under those conditions, and all we did was prove it. We'll get to that with the groundhog standings here shortly. I mean, she's just proven it. So there you go.
And also, Mark, it points out the fragility of get-rich-quick schemes. And I specifically am thinking of the meme stocks. I'm thinking of what's happened in the last 5 days to Bed Bath & Beyond, moving up by percentages just that any rational investor knows could not be real, and then just plunging down to near to low single digits in the matter of a day and a half on a little bit of news, and the incredulousness of a large part of the younger investing public that a stock like this would have I'm going to use another big word, the temerity to actually go down as much as it went up. To have all this roller coaster going on when anybody that paid half a mind to good, solid, conservative investing would understand that you can't make oodles of money on a regular basis in a stock that doesn't have anything pushing it forward as a business.
Yeah, the foundation's perhaps not in place in many cases.
Mark, I think you should take a screenshot of this particular screen right now with all your writing on it, and we could use it as an advertisement for the kind of analysis that we're doing on the stock market.
There you go. All right, well, let's switch to this one then. This one's a little bit more professional.
This one's better. Okay.
The blue line matters. No, I mean, yeah, the green bars overshoot and undershoot, but the pendulum does swing back to the blue line. You hear expressions, you'll hear it all the time from people talking on CNBC about reversion to the mean. It's really more mathematically correct to say reversion to the trend. And of course, companies that don't have a trend, that's a problem. But for this type of a situation, reversion to the trend is real and alive. We have, by the way, returned, even with the drop in overall stock prices, we've actually had a drop in the value line median appreciation projection such that it's actually back at average levels. So that means there has been a little bit of an erosion of fundamentals also, but nothing catastrophic.
So and since the beginning of this quarter, Mark, that last green line has started out below the blue line, has moved above the blue line, and now it's moved back to the blue line. It's gone in a lot of different directions since the beginning of this quarter.
Yep, and we've got a little over a month to go still, and it's been stock prices fluctuate. Imagine that. All right,
I will tell you, Mark, that I had an interesting conversation with a person that comes to the bull session all the time. And they were trying to convince me that this kind of growth was unsustainable. This trend line that's we could call it parabolic if you want to. was unsustainable. And when I tried to make the point that consistent growth graphed in a parabola on a regular graph, a Cartesian coordinate graph, I got into a huge argument. So I just want to make the point, folks, that graphed on the kind of graph paper that we use when we do a stock selection guide, this blue line would be straight. That's all I want to say, okay?
Okay. And I will, as an engineer statistician, agree with you.
Thank you.
I'm not gonna argue. We'll have to talk more about the argument. All right. So here's just a real quick note about Jim O'Shaughnessy. I know Jim. I met him at a conference years ago. I've talked to him a little bit. He is infamous for his price to sales ratio work done a few decades ago, and he runs a successful asset management firm. We're going to show a slide that comes from a presentation he made at Google as part of their Google Talks. This is available on YouTube. I listened to a part of it earlier today just to get inspired, as and his entire deck is there also. But he's got the same long-term perspective that we do, and the willingness to invest differently, and a continuous quest for excellent companies. So I would just recommend you take a look at it. And this is what I wanted to talk about, Ken. This is a slightly different way of capturing one of your favorite subjects. What he had done for a presentation a few years ago is pointed out the 50 periods that had negative or the lowest 10-year real returns. So you're going to see something on here that I don't do very often, and that is go back pre-1941. But there's a bunch of 1920s, 21s, and from the nasty period in the stock market back in the roaring 20s. And then you're going to see a bunch of 2008s, 2009s, and then just some other periods that there'd been a pretty nasty 10-year period in the market. And Ken is always, don't want to steal your thunder, but you basically are always saying, yeah, but look at what happens after that, especially when you go out 3, 5, and 10 years. And what I find fascinating here is out of a illustration that has 200 data points, only 8 or 9 of them are actually negative in the year after this really nasty period. And not a single one is negative for a 3, 5, or 10-year period. Because if we fill in these shaded squares, which I could do, I might do one of these days when I've got a little extra time on my hands, they would all be nicely positive. So it actually shows, especially if the bear has really been misbehaving badly, as we saw happen in 2009 and during COVID. I don't think we got to a point where the 10-year real return was negative, but I think this captures that spirit of, boy, when you're having a really nasty period in the stock market, it makes sense to find good companies at good prices.
Mark, can I interpret this graph and maybe make it so that it's absolutely clear to me and maybe clearer to a couple folks in our audience? Is that column right next to the date? Is that column right next to the date? That's backward looking for 10 years, right?
That's right. So this column is actually saying that after a 10-year period, you actually had negative returns. We last experienced that in 2008 or 2009.
Okay, and all the other columns are what happened then in the forward after the date, right? So that's what happened. The next column would be what happened for the year after the negative, right?
Mm-hmm.
Okay, and if I'm reading this correctly and looking at the ones that are in red, and there's not that many in red, I'm only seeing one that happened less than 100 years ago.
Yeah, I had not looked at it that way. You're right. It's the stuff.
Yeah, and I'm saying to myself, if we confine ourselves even to the last 100 years, this graph, which is pretty amazing just as it is, this table becomes even more amazing if we throw out the years to 19, 17, 18, 19, 20, and 21 from it.
Absolutely. It would
Yeah.
it would get even more
So
compelling
I
at
think,
that point.
yeah, I just think making that point that column right next to the date is backward looking, not forward looking. It's backward looking.
Yeah, and of course the stuff to the right is what actually happened in the
Yeah.
next year, the
Yeah.
next 3 years. And I just find it amazing. It's to me, it's the perfect recipe for when you're really depressed about what's going on in the stock market. It's time to go shopping. And it's pretty hard to argue with this. I mean, look at the box down here, this entire chart. Look at these numbers. Pretty hard to argue with that.
Yeah.
So again, backing up a couple of slides, during those periods when everybody at the barber shop and hair salon were basically saying run for the hills, stay out of stocks, this is what we were looking at. You would do 10 stock studies, 9 of them would be in the buy zone. And if you can find an excellent company in the buy zone under those conditions, this is the elixir that basically is the pathway to this area right here. It's the way to grit your teeth, pretend you're smiling, buy some stocks. It's just a massively wonderful thing, and maybe we'll find a different way to present this. Pretty powerful stuff. All right, good to go. Let's talk groundhog. David Einhorn is kicking up a little bit of dust here lately, so he takes over the celebrity lead in the contest. We do have a couple ladies jumping up to the head of the pack. Sean has dropped down to 5th.
The homepage, the front page of Manifest Investing, looking on the right-hand side of the front page, you'll see that there's a series of different dashboards that you can open up. And one of those series is titled Groundhog 2022. And if you click that, you'll get a list that's similar to this list. But if you click on any of the entries, that will drill down one more level and show you what their particular portfolio happens to be. Sean Mace was up at the top there for 3 or 4 weeks, and he's still in the top 10. Herb Lemkel with his Sin Soap and Soup has moved back into the top 10. And you can see that the Wilshire 5000 is at 32. So we have 30 of the investment portfolios actually beating the market right now. And we have a fair number knocking on the door, less than 1% behind the Wilshire. All in all, things look pretty good for the contest. The monkey has moved back up. At one point, about a week and a half ago, the monkey was down in 40th place or lower, but the monkey, Graham Stevens monkey, has moved back up to 22nd place. That's a random portfolio achieved by throwing darts. And it's not a portfolio I like to see up near the top. But there you are, Mark. Okay, you're back with us again.
Yeah, I think we're looking at internet issues here, thanks to the construction.
Okay, well, I've about talked myself out of this particular slide, so I think we can probably move on. We've gone through a lot of it. Okay.
Let's press on. Okay, best small companies. Just a quick update. Many of the companies that we've recently chosen are doing fairly well. We do note that our traditional buy and hold portfolio is now kind of matched up with the active, and we've got a little over a couple of months to go. We continue to hope to pass the Wilshire 5000, which is that market graphic. Some interesting action here going on. Boston Beers moved up. iRobots moved up on the acquisition by Amazon. We continue to cross our fingers and hope for the best. and make sure you factor in the scale here also.
Ensign has also made quite a move, hasn't it, Mark?
It has, yeah. That one has been crunching along pretty well.
Yeah.
Probably about the
I'll
same. I thought
admit,
about.
Mark, that we could stop the comparison right now, because this is what I would hope we would see during a 1 year period. I would hope that 1 year of managing would prove to be not much difference than holding for a year's period. And that's what it's showing right now. So let's stop the analysis and call this the truth, okay?
Okay.
I won't force you to do that, because I am a little bit disappointed that we're still not beating
Yeah.
the market with our small caps. But all in all, a pretty reasonable going forward of some stocks. And I think there's still hope for some of these stocks in the middle to move into the green before we hit September. What are we hitting? October 31st, before we hit
Mhm.
Halloween.
Yeah, we've
So
got a
let's
little time
see.
to run, so we'll continue to hope for the best. And again, that Russell 2000 just underscores how nasty of a market it's been. You can fight over definitions. The Russell 2000 growth cluster of stocks, it has been in a bear market and continues. And Friday and Monday didn't help a bit on this chart at all.
Mark, we have a hand in the air, and it's not one of our normal participants. So I'm going to unmute Cheryl and let her speak to us. This is Cheryl, and Cheryl, you'll have to unmute yourself. You're self-muted. But if you unmute, you can ask Mark a question. And Cheryl took her hand down, so it was an inadvertent hand, okay? So let's continue, Mark.
All right. All right, I thought we'd kind of close today with a look back at the last couple of years. Again, just kind of soul searching, seeking the types of things which are interesting to our audience and us. It's always good when we're all interested in similar things that we want to learn about. And all I did was went back and grabbed the sessions that have had the most views on YouTube. By the way, our number of attendees at these sessions has steadily increased over the last couple of years, and we have an extremely high attendance rate. Thank you all for that. And you can see up at the top, the sessions up at the top that you might remember. Interestingly enough, the first session from 2 years ago is right up there amongst the leaders. But we've covered a lot of interesting things, and I just tried to list some of the things. Right out of the box, we started talking about projected return on value, and we've featured a lot of best small company stuff. By the way, that is being Ken and I are basically kicking that off right now as we begin hunting for our companies that we'll choose on Halloween. And I've enjoyed the early stage investing stuff, the discussion of life after Google. What jumps at you here, Ken?
Well, I like the fact that we're looking at club questions, Mark. That was interesting to me, and I think that whole series that we did on club questions made an impact. In fact, such an impact that we used it for a couple of regular presentations. That might be something that we solicit again and run that through the mill again, asking individuals or clubs for their 2 or 3 most pressing questions about investing, or about investing clubs, either one.
Yeah, that was featured as Club American style or investment club style back in December 2020. We did a couple of sessions like around that similar framework, and we'll take a look at a few of the slides from some of these, including that one. And again, would encourage you to bring that type of stuff out and give us a chance to cover
The
it.
the other one The other one that I personally appreciated, Mark, was the one that we're using, Life After Google, as the title. It forced me to read a book that I would not normally have read. It forced me to stretch my mind and to consider things that are too easily ignored when you're retired. It's easy when you're retired to grab easy reads and sit in the easy chair, or prop your pillows up on your bed before you go to sleep and read something that's juicy and easy. But maybe we should be looking for a book every 4 or 5 months that we're encouraging our audience to read, and then do a fairly deep dive into what it's telling us. I really appreciated the book. I don't know if I agreed with all of it, but it certainly stretched my mind when I had to read things akin to what I used to read when I was working, and what I definitely used to read when I was going to school.
Yeah, and I do think that life after Google um, nudges some thinking. And in fact, I wonder, and I'm just wondering out loud here, um, if Facebook or Meta isn't going through some of the stuff that was predicted in that book with the threat to the business model, the advertising centered business model. And I think I might go back. I wish I had a Cliff's note of that book to, to go.
It
Maybe it's
really
up
would
there,
help, wouldn't
but
it?
I think I'd like to
Maybe
revisit some
one
of
to well, maybe one to explain the sources that he throws out there, as just everybody should know, whatever I'm talking about, and a lot of those sources I didn't know what the heck he was talking about, so I had to go look at them before I could figure out what the paragraph was talking about.
I agree. I did a lot of that also during that session. So these are some of the sessions that, again, you can access all these on YouTube. They're archived there if you want to go back and take a look at them. These this is kind of like comparing apples, oranges, and tangerines. There's a whole bunch of different time spans. In fact, I left up the one from just 2 weeks ago, the bull sessions from August 9th, and I'll show you why here in a second. So again, go back and take a look. Well, here's why. I think that the thing that we did 2 weeks ago was pretty powerful. And this is Peter Lynch basically giving us a general rule, which we went on to demonstrate with the roundtable tracking portfolio. And that being, you can invest $1,000 in a stock and have it go up. The most you can lose is 1,000, but you can gain 10,000, maybe 50,000. And we basically have done that. And we featured the stocks that had lost the most ground in the roundtable portfolio. The ones that are not highlighted are still active. By the way, Ardelyx is up about 10% from 2 weeks ago. One of the things that you guys did right while I was off for a week, got the price of Ardelyx up a little bit, but you did break
Well,
through.
what's that, about 22 cents, Mark? Or
It's up to $1 now.
I'm
89.
sorry, that was a really snarky comment. I'm sorry, Mark.
Yeah, so some people out there are panicking. Keep in mind that I added it to the roundtable portfolio at about 70 cents. So between fun, but here's the knockout quote. 700 decisions made over the last 12 years. And basically, you can add up all the losses for the losing positions, and they are more than compensated by a single company in the roundtable tracking portfolio. Again, basically showing you that Peter Lynch is right about this sort of thing. So I think this is kind of a pretty powerful slide that captures the long-term thing. And again, for those of you not familiar with the roundtable, we basically come together and try to come up with 4 or 5 good ideas that are actionable study candidates every month. Your thoughts, Ken?
Well, I told you 2 weeks ago that this is a slide I want to duplicate, and I'm going to steal it and use it in all kinds of presentations, and it's going to every one of my investment clubs as a just ponder this, folks, before you really get all embroiled about whether we should buy, hold, or sell something. Just ponder this and back up a couple steps, and don't get quite so panicky.
Yeah, I do think this used in combination with Buffett's dance card, where he talks about having 9 or 10 spaces on his dance card during a lifetime of really good ideas. Um, those two themes might go together fairly well. All right. So slipping back, speaking of Buffett, slipping back to the very first session that we did, we talked about Buffett, long-term returns of 12%. That's very Tom O'Hara-ish. We talked about the Fortune article. People are constantly saying that Buffett doesn't, or he's lost his touch, doesn't know what he's doing, and then he has a moment like the right side of this graph. But again, over the long term, pretty good stuff. The guys in the picture, by the way, on the left, it's Bill Ruin. The guy in the second from the left is Charlie Munger, Warren, and then the guy on the right is Walter Slosh. And they're featured in that Fortune article. And again, this notion of it's impossible to beat the market, we so fundamentally disagree with. You buy excellent companies and let them work for you. It can be done. There are no guarantees, but we work with a lot of investment clubs. In Ken's 19 investment clubs that he's a part of, they all have a pretty good track record. Good stuff. All right, another slide from that session a little over 2 years ago when we got started that you guys expressed a lot of interest in. In fact, this was just a few weeks later. You seem to like it when we do this sort of thing. We'll continue to try to do more of this. We're actually trying to display the companies that had solid upside-downside ratios. And there's some pretty good studies on this list also. All right. And of course, this, I'll let you take this one away, Ken. All of this activity actually spawned this.
Well, I just was so pleased with the response, not only from the audience but from the volunteers when we were canceling the convention time and time again, and basically the idea was put forward that we can do something. We can pull together somebody to speak, and we can show our universe, our community. We can show them 8 or 9 or 10 classes. We can do it for free, and we have the quality of speakers to make it interesting. This was, I think, is this the first one that we did? This is the third
That
one
would
we
be the
did.
third one, yeah.
Okay. Yeah, and that's just our panel across the screen right there. The people that consented to come together for about an hour and a half and make some stock picks, put their name next to a stock, and then take all the guff if they end up near the bottom of the list, and take all the praise if they ended up near the top of the list. It's the same thing we do at convention, and we ended up doing COVID cancellation conferences every 6 months or so. It might be time to rebrand this, Mark, and bring this back every winter, maybe once a year, maybe twice a year. I still think that the talent is out there to make the presentations, and the audiences certainly were. Without a whole lot of to do, and without a whole lot of pre-announcement, we were able to attract audiences in the 500 and 600s with only about 2 weeks notice for the event going on. So that's pretty decent. And again, just my thanks go out to all the folks that came to the conference, but also all the folks that help us get it together and make it something that people wanted to come to.
Yeah, and here's actually a quick look at, again, this is an example of some of the stocks that were selected back in, actually during the first COVID cancellation conference, dubbed COVID-1. And some pretty interesting picks. And again, keep in mind, this is a couple months after the start of the pandemic. So things were pretty bleak from an investing standpoint. Yet on here you can see, and this is some snapshot point in time, it would look a little different than this now. But this was basically a year later, how well those stock picks had done. And I think it's worthy of a wow.
Well, not only worthy of a wow mark, but it's also worthy of study. You get 8 or 9 good stock pickers together. You ask them to give you 2 or 3 ideas each, and darned if you don't get a list where half the names are unfamiliar. And it sharpens you, and it forces you maybe to research in areas where you don't normally look. It gives you a really good sense of what other people are thinking. And on top of that, it might even make you a few bucks if you stumble on the same great ones, like some of our folks did. You look at a Cy Lynch who is very quiet in his stock picks, but at this point in time, he was serving up 2 stocks that he chose, him and Pat Donnelly serving up 2 each. Well, I guess Mark likes this slide because he's even at the top of the list right there. Look at that. Robertson, too, also,
I like it
but
because there's a lot of
serving up
green.
as great stock ideas. Well, I thought you liked it because my name was at the bottom of the list, but
No, no. Hey, if you're going to complain about 50 and 35% returns, I'm gonna smack you. No, I mean,
No, I'm not complaining about any of those total returns in that total return column. But then again, maybe that column, Mark, goes back to what we were talking about earlier in this particular session about the phenomenal gains that were made in the years 2020 and 2021 in the stock market. And maybe they aren't. Maybe they can't be duplicated in the same general way for as many stocks as made those fantastic returns. Maybe that was a phenomenal up period, and maybe it was not typical of what the market normally does.
yeah, but it does bear out that 1 year from doomsday type situation. You may recall that Five Below, of
Absolutely.
course, is a retailer, and when Cy picked it, we're all sitting around going like, Cy, you are aware that all of their stores are closed, right? and, and he just said, yeah, that's a temporary condition, and it's
Yeah,
just
well,
an example of some pretty interesting thinking.
yep, yep.
And of course, I caught nothing but grief for buying all the car companies with that ETF cars, and that's actually turned out fairly well too. So again, that was a popular thing. Another thing that we did during that presentation was introduce this notion of theme-driven investment. I don't do much of this myself. A lot of people do this very successfully, and I think that this session led to some very interesting discussions about electric vehicles and that type of stuff.
And electric vehicle infrastructure, Mark, that
Mm-hmm.
opened up my investment club to a 3 or 4 month discussion about what was going to happen. Were these dates that the car companies were putting out of 2025 and 2030, were they realistic for the electric car company market and for the whole concept of electrification? I still don't think we're done with those discussion in 2 of my clubs.
No, and nor should we be. I think that some of the stuff going on right now, infrastructure is still at the very top of things. Maybe different aspects of infrastructure, but still out there. Then another thing we did during that particular session, again, this goes back to that moment in time when things were really bleak, pointing out some of the stocks that were picked with very, very low relative strength indices. That's what this RSI is here. So they're very much potentially oversold. And a lot of these companies had huge run-ups. The higher quality companies just had some massively huge run-ups subsequent to this presentation. So interesting stuff. I know I wanted to buy Chef's Warehouse. I encouraged my son-in-law to buy it, and by the time I could get the words out of my mouth, it was up 80%. back in the day. So just an example of some of the stuff we cover. This particular slide we've used a few times, and again, this goes to that. This was the first question from the investment clubs during the Love Investment Club style presentation, and again, it just points out that I think a community investing and with a well-honed philosophy and method can be quite successful. The type of discipline that's demonstrated, I'm just humbled and amazed at the amount of success that can be achieved. Again, no guarantees in this business. Everybody gets that. But this was the first question in that set of 20 or so, which we, again, duplicated on a couple of occasions. And it turned out to be very popular. All right. Again, another slide from that type of presentation, answering the question about the rule of 5. And this is, again, just an example of some of the stuff that's covered in that type of a presentation. The rule of 5 truly is a bell curve type distribution. And it flops around. All right, what do we got here next? Well, here's one of our favorite slides about all of the above investing. Again, answering a question from the investment club. And they were basically wondering if we talked about small company investing. And Ken and I are still wondering where that comes from, right, Ken? Where that skepticism comes from. We spent a lot of time talking about diversification by growth rate.
Don't you think, Mark, some of that skepticism comes from the fact that the talking heads on television, and for that matter, in a lot of the periodicals that we look at, specifically don't talk about smaller companies? They kind of confine themselves to a much smaller universe of stocks that they continually seem to want to talk about.
Well, yeah, it's driven by eyeballs too. Just a natural large company bias. Now, would you rather hear them talk about Littelfuse or Apple? I mean,
well, from their point of view, you talk about Apple because so many people own it. But from my point of view, I'd certainly like them to throw in a Littelfuse every 3 or 4 conversations, so that I have some other things to look at besides stocks that I'm pretty well versed in. I think that there's a total lack of focus many times on good quality small companies. I think what intrigues the TV personality and a lot of the news personalities, I think what intrigues them are small companies that are based on new ideas, not necessarily with any kind of a business model to back it up.
mm-hmm.
I mean, we hear an awful lot about small companies that are just going public, that don't have any earnings but are expected to have earnings in 4 years, 5 years, fill in the blank years. And I would love to hear about some good high quality small companies that I know a lot of these people that they interview are aware of, but I don't think that they're encouraged to talk about those kind of companies when they've only been given 90 seconds or
Mm-hmm.
2 minutes to make their case, whatever it is.
Yeah, and this slide makes the point perfectly. I mean, we talked about 11.2 earlier in the show, and here's 11.5 versus 5.6 with that lost decade in there. So yeah, the companies that are responsible for this differential are the companies that Ken was just talking about. So yeah, important stuff. And then we've talked a lot about better selling disciplines and principles. In this case, we were looking at what if we didn't have any sell decisions for the roundtable tracking portfolio. And you can see that if we simply jammed it all in the drawer, did not take advantage of or act on selling situations, It's actually quite a massive difference between 16.1 and 11.8 to achieve that really nice 16, and we're still at about 16%, even after the downdraft in the market for the roundtable tracking portfolio. So this basically just underscores the potential of making effective selling decisions from a portfolio. So unmanaged versus managed, it's made a difference so far. All right. And then again, just back in this time frame a couple of years ago, we were coming up on our 10-year anniversary. One of the more popular bull sessions we had was taking a look at the history of the roundtable, and have to say we have truly enjoyed this. The rate of return has floated in the upper teens for quite some time. The relative return has been in the 5 to 6 plus or minus range that you see here. Lots of good clean fun there too. All right. All right, Ken, I'll let you deal with this one. Again, just underscoring the triple play.
Well, we've been really interested in the triple play for a long time. It comes from a single paragraph, and it's a really small paragraph in the investor's manual, the one with the cover that you see on the slide right there. I think that particular manual has a 1984 copyright. I'm looking at it as I speak. It's in my hand, and that paragraph basically said that there were a certain kind of stock, there was a certain kind of stock that if you looked at those particular ideas near an end of a bear market, they should be the kind of ideas that rose to the top of the idea list. They weren't necessarily slam dunk buys, but if they had the three characteristics of the triple play, then they certainly were more interesting than stocks that didn't have the three characteristics. And you can practically, for in shorthand, you can say the stock needed to have a depressed stock price. This is the paragraph itself. Mark copied it directly from the manual. The stock needs to have a depressed stock price. The stock needs to have the potential for its profit margins to increase, and the stock needs to have the potential for its PE value to expand. You have all three of those things in place, and you have a candidate that probably has something of interest to a growth investor. Again, not a slam dunk. There's lots of triple plays that I don't end up investing in, but it certainly says that if you can find the triple plays, separate them from the entire list that you're looking at, they should be studied first. And that's the way I use that list entirely. Manifest has made it so easy for us to actually identify these triple plays in the screening tools. So all in all, why not use it if the ability is there to screen for them?
Yeah, and it was featured by Nicholson in an article in Better Investing magazine back in 1974 when he talked about using this technique. And during a particularly nasty period, remember the oil embargo and the gas lines and the odd and even numbered days, and Coca-Cola actually had made some missteps back during that time frame. Companies like Coca-Cola will make mistakes from time to time. So he saw the 1974 triple play condition as an interesting opportunity, and it certainly developed that way for him. So if you want to go back and read a little bit more about that, the link is at the bottom. One other thing that I thought we might go back and take a look at a future session, Ken, is you remember the regional conference in Lansing a few years ago. I'm guessing 8 or 9 years ago at this point, maybe more.
Try 15 or 16 years ago, Mark. All right.
Boy, the time is sure flying. Well, anyhow,
Yes, it is.
during that conference, we did a session on the triple play. Be kind of interesting to go back and look at that list of stocks that was generated and what has transpired since then. So really, that 16 years? Wow, it gives me an instant headache. All right. And again, just an encouragement to the audience. If you haven't yet latched onto this concept, we encourage you to do so. This notion of projected return on value. This is one of the slides from that, but again, it's as simple as looking at some measure of profitability divided by the investment in the enterprise value. And we just encourage you to wrap your arms around this one and take a closer look at it. We are using it fairly extensively, and return on capital is an important thing. All right. So in summary, there's the sessions. You can go back and revisit them if you want to go back and run up some of those view numbers. But I expect the session from 2 weeks ago that's out here in the upper left to actually go up as word spreads about some of those slides we talked about a few minutes ago. Any closing thoughts or comments on any of what you see here, Ken?
Well, I would just like to ask everybody that's in the audience, if you haven't subscribed to the channel for the roundtable, when you get to the first presentation that you want to look at, press the subscribe button, would you? We're trying to get to over 1,000 subscribers. I don't know how new this slide is that says 906, but we're close. And once we get to 1,000, it opens up some tools that we can use to make our YouTube channel even accessible and to make it more interesting for the people that are using it.
Good stuff. So with that, let's go ahead and leave with another picture of Burt Lake. I don't remember whether this was sunrise or sunset, but it was nice. We had ideal weather last week and no rain, all blue skies. Didn't see any northern lights. I don't know if there were any reports of northern lights down here. But
there were, Mark, and in fact, Natalie and I went out about, it must have been 4 days ago now, maybe 5, and we actually did see them down here way south in the state. They were telling people that anywhere from northern Oakland County north, you had the possibility of seeing them. And we just got things really lucky. It was crystal clear, beautiful night. And we went out and saw them not for a long time, for maybe 4 or 5 minutes we saw them. They were just as spectacular as when you and I and our wives stood on the grass in Burt Lake and watched them that one evening about,
right.
I don't know, 5 or 6 years ago. Yeah.
Well, I'm going to blame the adult beverages then because we missed them up north.
All right.
All right. So with that, I'm going to go ahead and shut down the recording. Hopefully that gives everybody a feel. If you're new to the bull sessions, some of the stuff that we have covered. Again, the invitation is to let's hear what you want to hear about. We didn't talk at all about the tequila trifecta, which got hammered last week, but has been very successful. So, Ken, perhaps you'll allow me to talk about that at some future bull session.
Absolutely, Mark. Okay.
It's a little bit different than some of the other stuff that we do, but I think worthy of discussion, especially when I see, and this is a subject for a future session, single stock ETFs. If somebody can explain this to me.
Oh, yeah, I listened to somebody justifying those 2 days ago, and when he finished his 4 or 5 minute justification, I thought to myself, "You didn't say anything. You just danced around the idea for 4 minutes there on television, and you don't really know, do you?"
Yeah, I got to think Jack Bogle's probably spinning, but anyhow, that's an example of a topic to kick around in the future.
Well, I give her kudos. The woman that was interviewing him started the interview by saying, "What exactly are they good for?" What it was, Melissa. Help me out with the last name,
Francis
Mark.
Buffett.
Melissa. No, no,
Melissa
no.
Francis?
Melissa, the woman that runs the program, the regular program where she has all the people debating underneath, Melissa Lee.
Melissa Lee, I knew that.
Uh,
I knew that.
yeah, and she looks at him. She goes, "What exactly are they useful for? What can you do with these that you can't do with just the stock itself?"
Good for her. All right. So again, bring us your things that you're curious about, especially if you've got an investment club or a modern investment club methodology question that you'd like to have answered. So with that, I'll say thanks, Ken, and we'll sign off for another week.
Thanks, Mark. Talk to you soon. Night, everybody.
Take care.